Hello, my name is Elliott Gue and I'm the editor of The Energy Strategist as well as Personal Finance. Today I want to talk a little bit about the broader markets and the outlook for the broader markets as well as the economy. First up, really the main driver for the broader markets this year so far has been the prospects for the U.S. economy. One of my favorite measures of U.S. economic health is the Index of Leading Economic Indicators, which is released every month by the Conference Board. It's really the summation of 10 individual economic indicators that have tended historically to be very good predictors of economic prospects 3 to 6 months in the future. I actually provided a very detailed analysis of this index in the last issue of my free e-zine, Pay Me Weekly, which is available at paymeweekly.com. But basically, out of the 10 indicators that make up that index, really only 2 are showing any signs of life. And those 2 are money supply growth. We're seeing the fastest growth in M2 money supply of the generation really right now. The other indicator is interest rate spreads. In other words, a measure of the steepness of the yield curve. A steep yield curve tends to be a pretty good predictor of easy monetary policy and therefore future economic growth. But those 2 indicators really are not what we need to see. It's certainly easy monetary conditions and easy money supply conditions, certainly things that have tended in the past to precede economic recovery. But those are really the 2 indicators that are most closely influenced by the government. Would like to see that money supply, that easy money, filter through into an improvement in other parts of the economy. So for right now, basically, I don't see much of a sign of life in the U.S. economy. I think we're probably going to see, when the final revisions come in, sub-negative 5% growth in the most recent quarter. And I think that you'll probably see only a very gradual recovery at best this year. Probably something in the latter half of the year is a better opportunity maybe for a little bit of a recovery for the U.S. economy. What does that mean for the markets? Well, what we saw is basically the markets came down hard, the broader markets came down hard last autumn. And found a low in November. There was a lot of sentiment about the stimulus package and some of the actions by the government that caused the market to have a nice rally going into January. Of course, as you all know, that's faded now and we're retesting those lows. One interesting thing to point out, which is a little bit of a sign of life, is that even though the S&P is basically at its November lows and the Dow has taken out its November lows, about 45% of all stocks in the S&P are actually trading higher than they were 3 months ago at the November low. At the same time, the number of new lows in the NYSE as a whole is much less now than it was back in November. What that does indicate to me is that from a breadth standpoint, looking out across the entire market, there are actually a lot of sectors and a lot of individual stocks which are performing reasonably well despite the broader market averages tumbling. The main reason for that, of course, is that the S&P is a market capitalization weighted index, which means that really the action of a few major components, mainly at this point in the financials area, is really governing the performance of that index. In personal finance, our strategy has been pretty simple. We've been looking for sectors that are defensive, recession resistant, or counter-cyclical. Those are the groups that are performing the best right now. Topping my list would be companies in the for-profit education industry. This is something we've written about extensively in personal finance as well as in Pay Me Weekly. Basically, when the economy's weak, unemployment's rising, a lot of people decide to go back to school to enhance their skills to university rather than going out into an uncertain job market. Another factor driving this is as part of the recent stimulus package, a major component of that is much higher education spending, includes increases to the size of Pell Grants over the coming years. And that really helps the financing for a lot of students entering university. At the same time, university or student loans have been one of the few areas of credit that's shown no signs of a slump as a result of the overall credit crunch in the economy. And that's basically because the U.S. government's pumping a lot of cash into direct loans to students. And also, they've also arranged for the Department of Education to buy up third-party loans, student loans, to add liquidity and keep that market functioning, and that's broadly worked so far. So the for-profit education industry is definitely a counter-cyclical group. The higher unemployment goes, the more enrollment growth that we're likely to see. The largest player in this market, which is our top pick in personal finance, actually saw overall growth in their enrollments of 18% year over year, which is pretty dramatic growth.